Stop believing the narrative that's pushed to you in the news. That's why everybody's tired of watching the news, because we don't know what to believe. But in today's video, I'm going to give you the absolute facts so that you can make the best decisions. I'm going to show you my track record over the past year and what I have said. All of that and more. Let's begin. You want that track record? Let's go real quick, okay? You could see it. This is in September of last year. Some are starting to say the bottom of the stock market route will be in October. Economy will be weak into next year. However, we'll see. That's what I said in September. You go through this and you see it for yourself in what I said. Look here, more and more and more. You go and scroll for yourself. This is the community or blog section of the channel. I wanted to just show you a couple points from it. Pivot is coming. This is entirely absurd and will result in the rapid destruction of the currencies. This flip is happening even faster than the most bullish had expected. Stay tuned. Get ready to buy the most garbage, worthless stocks because they are going to go up as the currency evaporates. That was in around that early October time. Okay, it says 10 months ago, but that's a generalization. You look further into this, and I said one more thing. You could see right here, I am seeing more and more research indicating that we are closer to a bottom in stocks in the US. Real estate's a different story. The economy itself is a whole different world. I don't know what will happen, but this is what's out there, and I want you to know. Of course, if we have a major escalation in Russia, Ukraine, or China, Taiwan, or some black swan that would flip everything, then all bets are off. I was pretty clear without giving you the, nudge, nudge, wink, wink. I think I made myself clear 3 times in a very short period where I was highlighting what I believe is happening based on the incoming data. Why did I know this? Well, there's something called the money mirror method, and I have been highlighting that many times before. I got a video breaking that all down. If you search money mirror method, the money GPS, you could see how I come to these conclusions, and it's all there, all public information. What I'm showing you here today is more indications of what's going on right now so that you know what's the deal, what's happening, right? Because there's always going to be information that you think is so strong, so obvious, and then you get another piece of information that completely contradicts it. It's because one may have more weight than the other, or the same exact thing, but because of some other condition that's happening at that very moment, it negates that entirely. So that's confusing, right? That's why economists are always just talking about this or that. They can keep their assets under management. They can keep their money flowing in. They just have to convince people that everything is going their way. It's all about the perceptions. Now, I want to show you something here. US inflation cooled while consumer spending picked up in June. You're seeing that, right? Well, the core PCE has gone to 4.1%. Mind you, this is still up from last year. But of course, in terms of the prices, but the rate at which it's going up is slower. I don't know why we would celebrate that, but that's what they do. Markets cheer UK inflation slowdown, but pain remains for households. So you could see in the UK, same situation, that has come down. UK inflation is officially, anyway, higher than what we see in the US, but the general direction for all countries has been that it's declining. The worry, of course, is that it goes from, all right, we're getting 10% inflation. Oh, now it's 5% inflation. Uh-oh, now it's 0, and now it's negative, and now we're moving into this, not just disinflation, but actual deflation. But we know that the central banks have made it very clear that they won't allow deflation to occur. They will do everything. But I am on your side. I understand this fully. And that's why I'm bringing you this content right here so that you can make the most informed decisions. Stick with me. I'm going to show you something. Here we have it. Fed says the U.S. banks tighten credit further in the wake of failures. Banks' loan demand remained weak in the past quarter. Commercial real estate was a particular focus of the tightening, and that is so key because what we are seeing in the commercial real estate industry is by far the weakest link. There's no doubt about that, and we know that we have seen the bank failures. We've seen regional banks. All right, the supposedly small lenders, yet they're loaning approximately half of all the loans is from these so-called small banks. And so they are the ones directly exposed to this commercial real estate that's having an issue right now. Retail and office are not in a good position. In fact, they're in a terrible position. So what the Federal Reserve is just highlighting here is that the banks have started to tighten up. They have said, we're not going to do as many loans as we did before. We're going to scrutinize this. And that means something, that there's a big concern for these banks. That means that there's a potential failure coming, one after the other. And that means job losses. That means potential stock market chaos. That's all going on right now today still. That has not turned around. And as long as interest rates remain elevated, this problem is there. I hope you get me. I hope you follow me. But we're not done yet. I want to show you something else. Janet Yellen, my favorite, sees a path to cool inflation with a healthy job market. U.S. economy proves more resilient than thought, according to Janet Yellen. And, they're just... Oh, this is all propaganda. Of course, they want to tell you that everything is okay, even if it's not. That's the point. The job market has been, of course, it's been very confusing, let's be honest. If you look at what's happening with the unemployment rate, then you look at how many open jobs there are, and then you look at what they would say is wage inflation, there's a big concern. The problem with wage inflation is that, yes, wages have gone up overall, not for everybody. The wages have gone up, but when you factor in inflation, they haven't done well over the past few years because the inflation is higher than that average increase in their wage. And that's a problem. That's why we need to provide ourselves, this is why I talk about it all the time, with the strategies to make money all around the clock, 24 hours a day. But if you're working that 9 to 5, you come home, you're tired. I understand. It's exhausting. You can't go then, I'm going to go wash windows. I'm going to go clean cars because you're exhausted. You're tired. You maybe got family obligations, all these kind of things. I understand. But that's why we need passive income strategies where, yes, we might have to work for a temporary period of time, but then we can have a means of bringing that money through. This is so important. I teach this very regularly, especially to the mentorship group, but the information's out there on my YouTube channel as well and on the Discord. Discord is a place where I share a lot of stuff as well. You definitely want to check that out. Look, I thought this was important. During the tightening cycle, the economy typically expands at its fastest pace, and it feeds off of the lagged effects of the prior period of policy accommodation. It slows down precipitously in the 2 years that follow the end of the tightening cycle. So what we are experiencing right now is a tightening cycle. The economy is, it's ebbing and flowing. Okay, it's not just one direction. But of course, there's some very clear problems that have emerged. But again, you look at, and you'll find this, I know you see this all the time. There's going to be those YouTubers, the news, the online, the New York Times and all these, they're going to stick to a limited set of data. And when they show you that, it creates a bias. And then if you agree with that bias, you are going to be more likely to essentially get on that train. You're going to say, I like the New York Times. I like this YouTuber because I agree with the bias that they have. But when we are presented with all of the data, it becomes much more complex. It's exponentially more complex to understand it because there's so many moving parts, and I get that. I'm about to show you two things that are, in a sense, contradictory, but the story it tells is the same. Watch, let me show you. This is the yield curve inversion. And you may be aware of this. Essentially, it's in fact, it is one of the best, most accurate indications of a incoming recession. So we go inverted when we steepen, when we go in the other direction. That is when we have a recession. It's just a matter of fact. Okay, we start to turn the other direction. And in this case here, this is the mean of major, basically all the economies, the 2-year, the 2 and the 10, 2-year, 10-year yield curves. When we compare these two, that gives us a very good indication historically that we are going to feel a recession in the next little while. That is extremely broad, extremely general. But what I'm trying to say is that when the bond market does this flip, we get a recession. Okay. Very long-winded, I know. But what about real yield curves? Those continue to flatten. What is a real yield curve? That is essentially when you factor in inflation. What do we get? Now, this is a little different. There's a 3-month and the 10-year. And we're also looking at US, Germany, UK. Just as a whole, you can see the general direction, though. So while we have not steepened in these cases here, factoring in inflation, this is just something that I wanted to show you. It's, as I said, something that is important to see the indicators like this popping up. We got to pay attention. And that's all it is. You can judge it how you want to. You could say this is that and this is. The point here is that the indicators have popped up. So what do you got to do? Well, you know that there's slowdown happening in some cases. You know that there are parts of the stock market that have gone to over, just nonsense levels. We know this. We're getting the vibe of the SPACs and the NFTs, and the metaverse. All that is coming up again. And so what we need to do is position ourselves accordingly. We can mitigate some of that risk by hedging our bets, by starting to say, okay, I've made some good money here. I'm going to start to trim my winnings. Or I'm going to take money out of some of these savings accounts that people have them in, and I could put it in a money market fund maybe. I can earn 5% in a money market fund. I could put my savings into some of those, into some ETFs right now that are passively giving 5%. Now, 5% is not very good in the sense, but I want my money at least versus 0%. I would take 5%. And at the same time, we're not going to put everything. People just move everything. And usually it's because they don't have much to invest in the first place. And that's the kind of balance that we have to have. It is so important for people to understand where they are so that they can make the right decisions, all right? Soft landing optimism is everywhere. That's happened before. Uh-oh, what do we have here? People are often sure that the economy is going to settle down gently right before it plunges into a recession, a reason for caution and humility. So essentially just saying that we've heard this all before. You know how it goes. Late 2000, 2007, every single time they say a soft landing is here, you don't have to worry. Ben Bernanke said subprime is contained. But then we learned our lesson. No, of course not. We didn't learn our lesson. But this time is different. Is it? I don't know. I can't tell you if they're going to admit a recession, it's going to be job losses and everything else. But I can definitely tell you that where we are at today is worrisome, and we just got to position ourselves to not take the big losses, but still potentially bring in income or keep up with the level of inflation at the very least. Because if we're sitting on our hands, we're in big trouble. So some of that information I have in my books, but if you want some free stuff, it's all available on Discord. Discord is an app. It's like a little chat app, but I managed to sneak in a whole bunch of information into there and give it all away for you to check out. It's right down there. It's free app, Discord. If you're not aware of it, definitely check it out. There are well over 800 people. We are heading towards 1,000 people very soon on Discord. Check it out, click it, and I'll see you there.